Assalamualaikum everyone, welcome back. Today I'm going to discuss some questions regarding honors equity section of the balance sheet, and this is chapter number 16 of corporate financial reporting. And I have two different questions to discuss in this chapter with you. The first one, we will be looking into the effects of different transactions on three different accounts of the companies. Number one, the first one is the net profit, how each and every of these transactions, the one which are listed over here, are going to affect the profits of the are going to affect the net profit of the company, and how they are going to affect the retained earnings of the company, also how they are going to affect the stockholders equity, total stockholders equity. So this total stockholders equity includes both common stock, or you can say share capital, better to write share capital, and reinvested capital, or you can say retained earnings. This one is also the part of it. Okay, so let's start from the first transaction. A stock dividend is declared and paid. Now we all know that stock dividend is coming up with the issuance of new shares, right? So when the new shares are issued, then what happen? Retained earning gets debit, they decreases because we pay the dividends out of the retained earnings. At the same time, common stock will get credit because we will issue the new shares, so common stock will increase. So let's see the journal entries effect. Of course, profit is not going to be affected because it has nothing to do with your income statement. But if you see here, retained earnings will decrease. Total stockholder equity will have no effect. It will be zero. Why? Because on one side, retained earnings are decreasing, so this is decreasing. At the same time, the other account of total stockholders equity, that is common stock, that is increasing. So both of them are going to cancel the effects of each other. That's why there is not going to be any effect on the total stockholders equity. The second one is merchandise is purchased on credit. When you do the purchases on credit, inventory gets debit and accounts payable gets credit. Inventory is an asset, accounts payable is a liability, so none of these account is going to be affected, right? Third one, marketable securities are sold above cost. When you sell the marketable securities above cost, you get money, cash gets debit, and the marketable securities will get credit. You sell them above their cost. For example, the cost was 1000, you sold them for 1200, so you have a gain on sale of 200. This gain on sale of securities is going to increase your profit because it is mentioned in other income section of the income statement. So your net profit is going to increase because of this gain. Also, your net profit is going to increase your retained earnings, and retained earnings are going to increase the owner's equity. Cash is an asset, marketable securities is an asset, so they are not asking about assets. Point number 4, accounts receivable are collected. When you collect the accounts receivable, the journal entry to record this is you get debit the cash and you credit accounts receivable. Both of them are asset account. So no effect on profit, no effect on retained earnings, no effect on equity. Moving on towards point number 5. A cash dividend is declared and paid. So when you pay the cash dividend, on one side retained earnings decrease, on the other side cash decrease. So both the accounts does not affect your income statement, so net profit is not going to be affected. It clearly says that the retained earning will decrease, so decrease in the retained earnings. Since the retained earnings are decreasing, so equity will also decrease because equity contains retained earnings. Point number 6, or F. Treasury stock is purchased and recorded at cost. So when you purchase the treasury stock gets debit and cash gets credit. Treasury stock is an owner's equity account and it's a contra equity account. It decreases your equity. So in this transaction, nothing is going to happen with the profit, nothing is going to happen with the retained earnings, but yes, total stockholders equity will decrease because treasury share is a contra asset, a contra equity account. Point number G, treasury stock is sold above cost. So when the treasury stock is sold above cost, what happened? You get cash because sale is happening. Treasury stock will get credit. For example, treasury stock's value was $10. They said above cost you sell it. So for example, you get $12. So $2 is additional paid in capital for the treasury stock. Right? We talked about it when we were discussing about the chapter. So what will happen? Cash is going to increase your asset. They're not asking about asset. Treasury stock, when it will decrease, your equity will increase. At the same time, additional paid in capital is going to increase the additional capital in the equity section. So owner's equity is going to increase, but no effect on retained earnings, no effect on profit. Point number H, common stock is sold. When you sell the common stock, you get cash and common stock gets credit. So profit is not going to affect, retained earning is not going to be affected, but yes, equity will increase because of common stock. Point number I, a fixed asset is sold for less than the book value. So when you sell an asset less than its book value, you get money. For example, you sell some equipment, because they said an fixed asset, so let's talk about equipment for example, and they said you sell it less than the book value. So for example, the book value was 12,000, but you sold it for 8,000, so debit side is smaller, so we will be having loss on sale of asset with 4,000. This loss on sale of asset is going to decrease your net profit. Net profit decrease is going to decrease your retained earnings. Retained earning decrease is going to decrease total owner's equity. Finally, bonds are converted into common stock. So bonds payable will get debit and common stock will get credit. It will increase, bonds payable will decrease. So no effect on net profit, no effect on retained earning, but yes, equity will increase because of common stock. I hope you got the idea about it. Let's talk about, there is another question regarding this chapter. So let's see the effects of different transactions on the company's different financial statements. So following note is taken from the Walt Disney Company's 2004 annual report. The company declared an annual dividend of 0.24 per share on December 1st, 2004 related to the fiscal year 2004. So on December 1st, they have declared a dividend of 0.24. They declared the dividend on December 1st, so this is a declaration date. The dividend is payable on January 6, 2005. So this will be the payment date to the shareholders of record on December 10. So the record date is December 10. So declaration date is December 1. Record date is December 10. And the payment date is January 6. We know that there is a journal entry on declaration date when dividend becomes a liability. There is a journal entry on the payment date when we remove our liability by paying the dividend. And on the record date, we do not have any journal entry because company updates its records with the names of the new owners or the addresses of the new owners. So let's read further. The company paid $430 million dividend, 0.21 per share during the first quarter of the fiscal 2004. So in 2004 first quarter, which was January, February and March, company has already paid 430 million dividend. Okay, so in 2004 basically two times they have one time they paid the dividend and the second time they only declared because the payment will be next year. During the fourth quarter of the fiscal year 2004, fourth quarter means the last 3 months, the company repurchased 14.9 million shares of the Disney common stock. So, repurchase of shares means they purchased the treasury stock for approximately $335 million. As of September 30, 2004, the company had authorized in place to repurchase approximately 315 million additional shares. They still have authority to repurchase the shares, but they only repurchased 14.9 million shares. Okay. Based on the above notes, answer the following questions. So we need to give some answers. Explain what would be recorded on each date related to 0.24 shares dividend. So we need to calculate that what we are going to record. So they are actually asking about the journal entries. I already told you about the 3 dates, and we know the 2 dates on which we need to pass the journal entry. Regarding 0.24 dividend per share. So this is the dividend per share 0.24. They did not specify clearly the number of the shares, but we can calculate them. If we read this line, the company paid 430 million dividend, and per share dividend was 0.21 in the first quarter, divided by 0.21. Right, so we can calculate the number of the shares. So 430 divided by 0.21, you will get an answer of around 2040. Let's take a rounded figure, 2048 shares, of course in million. Okay, so these are the number of shares. To these shares, company has given 0.21 dividend already, so that was 430 million, right? Now we can use this number to record the journal entries for this 0.24 dividend. So let's do this. So the 3 dates are, it's over here. First date, which is the declaration date, company will pay will decrease the retained earnings because dividend is paid out of the retained earnings, and at the same time the dividend becomes the liability. I gave you the number of shares, that is 248 million, and each share dividend is 0.24. So we can calculate the amount multiplied by 0.24. So that will become, if you take the rounded figure, that will be 492. So this is the amount which you will be recording as retained earnings, and dividend payable gets credit. On the date of record, there will be no journal entry. On the date of payment, this dividend will be paid. So 492 million, of course they are in million, will get debit, and 492 million cash will get credit. Let's talk about point number B. How would the 430 million dividend payment affects each of the 3 principal financial statements? So they are talking about income statement, they're talking about balance sheet, and cash flow statement. So we know that this one, if you see this, which is already paid, how it's going to be affecting these 3 statements during 2004. Okay, so we all know that dividends have nothing to do with the income statement. They are of course based on the net profits, but they does not affect your income statement accounts, so it will have no effect on income statement. Whereas in balance sheet, cash will decrease. Cash is already decreased with $430 million. Also the retained earnings get decreased with $430 million in the balance sheet. Whereas cash flow statement financing activity section will show a decrease of $430 million because of dividend payment. So financial activities in the cash flow statement will get affected. Let's talk about point number C. How would the 335 million repurchase of Disney common stock affect each of the 3 principal financial statements? When the company repurchases the shares, treasury shares gets debit and cash gets credit. So if you see, both of them are balance sheet accounts, so income statement again is not going to be affected. In the balance sheet, on one side, asset side, cash will decrease because of this repurchase. On the other side, equity will decrease because of the treasury shares, as they are contra equity account. Let's talk about cash flow statement. In cash flow statement, because it's relevant to owner's equity, so financing activities are going to decrease because of this repurchase. So this is how different parts of the financial statements are affected because of the transactions which are relevant to the owner's equity section. This is it about the discussion of chapter number 16. Hope you understand these questions. If you have any confusions, please write in the comment section. Inshallah, I will be answering them soon. Take care, everyone. Have a nice day.